All right, we got the live stream going. Oh man, that sucks. You stayed up a little too late. Hopefully it doesn't get in the way, my man, of you having a good time here. Sorry to hear about your back issues, my man. All right, all right. Let's get this show started. Hello, you guys. We're going to the desktop this stream. So on the left here, we got Discord. On the right, we got TradingView. And here, we have a bunch of research, as you can see. We got some stuff to talk about, particularly some of the recent actions that have happened with the BoJ. Now, all in all, if you just want the quick analysis of what's happened today and my thoughts, that's all right here in the general chat. You can just see my little blurb on all the stuff that's happened today from the research roundup. And the research roundup, FYI, are these things here, where I post updates to all the major research channels. So these are all the threads for every central bank. We just had the BoJ today, so we have reviews and a bunch of analysis coming out about the BoJ. So if we go into the BoJ thread, we'll see all sorts of stuff in here that came out today. We have a Western Nakamura tweet that we'll be covering over here, if I'm not mistaken. Western always has some very good commentary. And when I read this, and I was like, no way they didn't do that. And then, yep, they did. And then here's the full-size picture of that, where it's originally sourced from. And these are all the official BoJ links in here, and then some Nikkei articles as well, from Nikkei's analysis point of view. So yeah, there's all sorts of good stuff in here. And if you go back to that announcements channel and to this research roundup for the day, there's all sorts of outlooks for FX and New Zealand in particular. The Bank of Japan also released an economic activity outlook, and I'll kind of check that out. I know that, how big is that document? Let's see. It's about 11 pages, so, we'll go over the summary here on the first page, and then we'll leave it at that. I think that's a pretty fair approach. And let me see you guys who are here saying hi, say whatever, leave your money bags in the chat. And then we'll be going over a couple of trades that we had in the trade group. As you can see, I have access to the Boss Trading Group here. You can see everyone's threads. I'm not going to show other people's threads here on the stream, but I will show my thread. And then we have a new ping here in forex. Oh, hey, it's Noza. Funny how the chart showed up. What was going to happen in July? Yeah, my man. Good stuff. Good stuff. Yeah. Big day on the dollar yen. Let's check it out on the chart. Nice to see Noza in here. Nice to see Noza. Noza's a good guy. And here's the outlooks channel, FYI. So if instead of having this research outlooks, this research roundup, you can just go here, check out everything that's been posted over the last few days. There's some good stuff in here. And you can check out this crazy chart here on the right as we do all this. Yeah, man. Having the whole desktop view is a whole different sort of viewing experience. Yeah, would not be surprised to see this move a tad higher, at least on the week. But then again, let's pull it up for the month. And because we're at the end of the month, I'm going to open this up so that then we can see next month's range probabilities. And I'll full screen this. Okay. So here we go. So yeah, pretty flat range, pretty wide range. So I'd say 152 and a half, 152 and a quarter, so call it 152.6 to 0.8 this this spot right here, that's roughly the peak for where most of the time you find the month. I mean, that's kind of where we topped out here for this month. Yeah. I'd be cautious once we start going past, call it 153.3.4, because this is all tail risk guessing stuff. This is pretty hard to trade. But taking some shots on the short side here or some shots on the short side here, those aren't the worst ideas in the world. So maybe someone is looking at this chart and saying, oh, maybe there's something like this, right? Or something like that, right? But we'll have to wait and see. It honestly depends on how high these yields move. And specifically, we can pull up our yield spreads. Wow, check that out. Huge up move. But the yield spreads have just been really getting hit hard, especially today. Whoa. Misclick. Okay. Yeah, these yield spreads are starting to get pretty darn negative. These are the most negative yield spreads we've had since the 31st of August. So I would not be surprised. Yeah, you definitely, when the yield spreads get particularly negative, things can move lower. And now that the yields in Japan are theoretically uncapped, and I'll show you what I mean by that. Let's go over to Weston Nakamura's tweet for some easy analysis. BoJ policy statement just got rid of any explicit upper band ceiling to yield curve control. That's the primary issue here. So when we actually go and see what the BoJ said, effectively the easiest thing to do is just to look at this little graph here. See how there's a red line here at 1%? And now there's no red line? Well, the Bank of Japan is saying, well, if it goes above 1%, we will intervene to our discretion. But we're not going to set an explicit limit to where we're going to begin getting involved. So we're just going to remove this strict capping on 10-year JGBs. And it's not just the 10-year JGB, mind you. They've had to instate this sort of policy generally across the entire curve, across all the durations. And now that they've done it for the 10-year, it's pretty much implied that they're going to end up doing this across their entire curve. So they're just going to let the markets go at it and let the yields go to where they need to and intervene when they feel like it, effectively. Yeah, the Ministry of Finance probably stepped in and said, you need to compromise on something here. Let's check out what the Bank of Japan specifically is concerned about. So, the Japanese economy is likely to continue recovering moderately for the time being. Supported by pent-up demand, although it is expected to be under downward pressure stemming from a slowdown in the pace of recovery in overseas economies. So that is a huge mouthful in the very first sentence, but I want to point this out. This one sentence is effectively the entire theme of yesterday's stream, which was the primary concern of a lot of institutions from the outlooks that I was reading for the week ahead last Friday. Their concerns were mostly about where relative changes in growth and inflation were going to move going forward. When you read this from the Bank of Japan, and this part of the sentence after the comma, although it is expected to be under downward pressure stemming from a slowdown in the pace of recovery in overseas economies. So they are comparing some of the weakness in Japan to some of the weakness in overseas economies. The relative strength of Japan compared to other economies is the primary concern of the Bank of Japan kind of at the current point in time. A lot of people are still concerned in 2024 during the first or the second quarter of next year that the US will go into recession, that Europe is probably already in one, that Australia could get into one in the first quarter, same thing with New Zealand, potentially Canada later in the fourth or early in the first quarter. The timing that this expectation that a recession is going to come is there, but it's still kind of in the same spot as how everyone thought a recession was going to have started at this time of year at the beginning of 2023. Remember that during the beginning, the first half of 2023, every analyst under the sun thought, oh, recession's going to start. And there were a few dissenters, right? And as the markets got stronger, I mean, even I made a video talking about, oh man, this doesn't look good. But then stock market just kept getting stronger and stronger. And either you lose your opinion or you lose your money. It's as simple as that. And in this scenario, while the base case scenario for a lot of institutions and a lot of expectations is, hey, we really see that there's a big risk of recession here. So long the slowdowns in all of these economies relative to each other are not accelerating. See, that's the stemming point. Under downward pressure stemming from a slowdown in the pace of recovery. So long the rate of change of this rate of change is not accelerating, right? The second derivative here is not accelerating. Then China doesn't collapse, and the geopolitical situation with Israel and Gaza doesn't escalate with Iran, right? Hopefully the Lebanese government does, even though they're poor, does something, right? There's a lot of risks economically, geopolitically, right? That we have to constantly have our eye on. And it's only until those risk events actually realize themselves that we need to be concerned about a recession. So it's like there's a guy standing there with a knife pointing it at you saying, I'm going to cause a recession, I'm going to cause a recession. But so long you keep your distance and so long you don't let him get too close to you, and if he does get too close to you, you take some action to defend yourself, everything on your end should be fine. It's just a matter of keeping your eye on the ball and figuring out what it is exactly that all these major market participants are looking at as their signal for this rollover to potentially accelerate. And that seems to be the labor market. So if I go into this document and I do a Control F search for labor, oh wow, there's 16 results for it. So in the household sector, employment is likely to continue rising, but the pace of increase is projected to moderate gradually. This is because it will become more difficult for labor supply to increase. With labor force participation of women and seniors having advanced to a high degree thus far, that said, these developments can lead to an increased tightening of labor market conditions during the course of the economic recovery. In this situation, so now they're talking about the ramifications of a tightening labor market, wage growth is expected to increase as a trend. Wage growth, wage price spiral, higher inflation. Oh, let's uncap the yields. Partly reflecting price rises, and employee income is projected to continue increasing against the backdrop, although private consumption is expected to be affected by the price increases. So everything is going up and discretionary spending is going down. It is projected to keep increasing moderately for the time being. I mean, again, I said I'm not going to go through this whole thing, but one of the major pinpoint things to keep your eye on that I will stress probably for the rest of the year in every single one of these streams is look at labor. Look at labor. Because, I mean, there's a lot of people looking at housing as a signal for the rollover, but there's all sorts of other factors that go into housing. And then it also depends on which country's housing you're looking at. Labor can, you know, labor is probably going to have more of an impact, frankly. It's probably going to have as big of an impact, right? A lot of inflation measures are mostly rent and housing and shelter costs, right? But those housing and shelter costs can be increased or decreased depending on wages, right? And also, if inflation goes higher because of those wages, then the yields go higher. Thus, when you get a 10 or 30-year or 20-year mortgage, when inflation goes higher, those yields go higher. You end up with more expensive payments for your shelter. It's important to understand these dynamics so then you can deduce, oh, here are the important factors. Oh, if this component changes, here's how it changes these other components. And thus, that's how I should update my expectations for various economies and assets. It's just knowing as much as you can about the world around you, how people are affected by these different economic measures. And then, at least what I'm showing in these streams is we're going into these markets and speculating, right? Now, for example, on this dollar yen, I did not participate on this dollar yen. I participated on euro dollar, and I got stopped out on that one here on this spike higher. But it's not a huge loss. I already made my money back, like I typically do. Because I got long right here at the... Well, I mean, this was yesterday in the trade group. That was kind of nutty. Yeah, check that out. Check that out. This was from... And we can use the replay function in TradingView to get this to show you what it looked like yesterday. Yeah. So about that spot, actually, I can go into the Discord and show the whole timestamp. Yeah, because I got Discord open here. And then Aussie. So yeah, there you go. That's the timestamp. And so far, so good. I mean, I thought this thing was going to go lower, but I was surprised. So I did pretty all right on that one. I got exposure. And then Aussie dollar was the other one here that I took shortly after. I think this was the better trade, in all seriousness. The probabilities were much better yesterday, and I'll just rewind and show you what I was looking at. So you could see we had our peak here in the daily range, took some shots here. That's usually not the smartest idea in the world, but going into today, thinking that the BoJ was going to effectively let the yields go higher because of that leak from Nikkei. Well, now they've technically done something even more hawkish than that. So, yeah. There was quite a bit of volatility here, and I woke up around here sometime during the middle of the night. I'm like, oh, shit. I'm going to get hit again. But no, thing went all the way back down. So, nice and easy setup for me. So, sucks on that euro dollar, but 2 out of 3 ain't bad, Mike, man. 2 out of 3 ain't bad. All right, let's see what you guys have to say in the chat. Why is yen weak when BoJ removed the cap on yield curve control? Well, because it's a form of monetary tightening when the yields increase. Will it mean that the BoJ hikes rates soon? No, they're expected to do their first rate hike sometime next year, though. At least based off what I have last read. I mean, we're now 30 minutes into the stream, and I've hardly got through half of this research. I mean, this is why it's so important, you guys, when you do involved in actually doing trade research, that you get good at reading relatively quick. Like spend time learning basic definitions and words of all these things. And if you're even slightly confused on any of this stuff, just go into a channel. You know, if you don't know what channel to use, just use the general chat, right? Because general chat's kind of a catch-all. So if you don't know, like, where you want to post, just post it into the general chat. No one's going to yell at you. But if you, let's say, are trying to figure out some stuff around this central bank outlooks, go into the central banks channel, say, hey, I'm trying to understand this better. Or better yet, you can go into the research forum and check out all these different threads on all these different topics, like the BoJ stuff. And there's a whole thread here that you can say, hey, you know, what's going on with this BoJ meeting? How do we interpret this correctly? What are other people looking at? And how are other institutions interpreting this event? Getting good at how to do this is kind of the whole point. Like, if you don't know what it is you're trading, it will be much harder for you to make decent trading decisions. But I think that's quite straightforward. In any single disclaimer for any exchange or financial product or anything financial, there's always going to be some disclaimer where they say, hey, you are going to sign this waiver saying you understand all the risks, right? Well, what's the point in signing that if you don't actually understand all the risks? So you don't literally, I never always sign those things understanding every single possible risk, because every single there's an infinite amount of possible risks, right? However, there's only a limited amount of exposure you can ever have. So it's important that you know, for the things that you get exposure to, what are the risks to the exposure you're taking. And it turns out there's only generally a finite amount of most probable things that can impact you there. And then some tail risk things that you have to take into account. Yeah. So you need to understand the expectations, right? What's expected of these sorts of events going into the event. And then you need some sort of valuation tool. You know, I have range probabilities and I sell this, right? And then I have a trade group where we go over this sort of stuff using this indicator, looking at our own research, right? Looking at our own stuff. I'm just very happy with the people who are in the trade group. They're doing all their trades and research autonomously. Like, no signals in this group required. But it's very, very nice to see everyone doing what they're doing best. But yeah, I would expect a BoJ rate hike sometime next year. That's the current expectation that I understand. Hello, Princely. Nice to see you. Joining the stream. We got a bit of an update Eurozone inflation. I mean, we can go here and look at TradingView's calendar and we can just see the Eurozone inflation metrics come out. So let's see here. Chicago PMI, that came in lower. Case-Shiller, housing prices went higher, significantly higher in the US. Year over year, housing prices went higher. So that means US inflation's probably going to continue rising. That ain't good. Employment, yeah, that went higher. Okay, and then here's the European inflation metrics. PPI in Italy went down. That's nice. Let's see here. Yields in Italy going down. Nice. Inflation in Italy also going lower. Inflation in Europe lower than forecast. That's actually quite good. So let's read the article now that we have the numbers. Eurozone inflation lowest since July 2021. So inflation in, you guys can see it a little easier for you guys viewing on the phone. Inflation in the Eurozone is falling fast and the economy has begun contracting. Data showed on Tuesday, illustrating the dual impact of a steady diet of European central bank interest rate hikes. I think Keith McCullough from Hedgeye was just saying, I think yesterday in his macro video series that he has on his platform, that now Old Wall is finally getting it through their thick skulls that Europe is in a recession. The economy has begun contracting. Well, according to Keith and his models, it's been contracting for like the last 2 quarters. Oh, man. Good stuff, good stuff. I have a question about the BoJ. From what I understand about currency exchange rate, the yen has been falling because of BoJ yield control, but currency keeps falling versus the dollar. Well, this just means that Japan has some room short term to inflate. All this stuff essentially means, short term, we're going to be getting some more inflation. And until that inflation, I mean, here's the easiest way. I mean, I finally get to use my black screen for my drawing. So let me do this. Hey, look at this. I have drawing stuff now. Cool. So let's do this. So here we have the BoJ meeting, BoJ, right? And let's do a little timeline thing from here to here. Cool. So today's BoJ meeting, let's say, happens right here. They say, okay, we're going to uncap the yields. Well, the yields don't necessarily have a reason to move quite yet. Why? Well, because they need to see the next inflation print, so then they know how to price the yield. The yields are priced in reaction to inflation. So let's say we get a CPI for Japan over here, right? JP. That's the country code. So now, let's say this is yields over here. This little thing is yields. Let's go ahead and color that, I don't know, red. So from here to here, yields will probably just drift a bit higher in anticipation. And then if, let's say, CPI comes out higher, then the yields are going to really go up higher. And at that point, it's probably going to reach the 1% level here. At this point, it'll probably hit 1%. And so the BoJ is looking ahead, and they're saying, oh, crap, once we get to this CPI coming up, if we go into this 1% cap, we're going to have to buy so many bonds. So many bonds. And that would probably really send the Japanese currency down a lot. Because effectively, they have to print all that money to buy all those bonds. So instead, what they're doing is they're saying, okay, we're just going to remove that little cap at 1% and just let things roll forward. So now you're, instead of getting let's say a yield like this going into CPI, and then seeing it go like that against a 1% cap, what you're going to end up having is a little bit of a drift into CPI, and then it's going to go higher. So these yields will go way above 1% now, because it's up to the central bank's discretion. And this can make the yen appreciate. Because now all these Japanese investors are looking at this yield that's above 1%, and they're like, oh man, we should be taking our money out of some places in the world and putting it into this yield. There's going to be kind of this inverse carry trade moment for the yen, man. It's going to be cool. It's going to be a whole different regime for the Japanese people. How they interact with their currency, how they use it. In all seriousness, I'm not totally 100% certain how much of that I got right. You know, maybe some Japanese yen expert, you know, it'd be, I mean, hell, you know, if Western Nakamura gave me some commentary and some notes on that little bit of analysis, I would really appreciate it, because I'm always trying to get better at doing analysis. It's one of the main reasons why I read guys like Weston. And let's actually check out what Weston has to say. Looks like he's posted some new stuff. Let's see here. When major market headlines drop, those who risk to Twitter first equals those in the game. Gotcha. BoJ changes upper bound for 10-year to target to 1%. People, media, do not know what they're talking about. What the hell? So the BoJ releases this, and then some people in the media are saying, no, they changed it only to 1%. Obviously not. Wow, check that out. So this is another geopolitical thing to keep an eye on. Support for Kishida's government was ebbed. More people do not support Kishida's government. And when you plot the dollar-yen exchange rate across a sentiment index of support for the current prime minister of Japan, it's like, it just follows it perfectly. Just look at that here. I'm going to open this image in a new tab. That is hilarious. Isn't that crazy, man? Oh, that is nutty. Dollar yen is like a fractal of the do not support for the current Japanese PM. So let's see here. Any interesting commentary? Two things. Longer term, Japan's massive government debt and deficit levels and how much more the Ministry of Finance has to pay in borrowing costs will be the cap that ultimately calls the BoJ's yield curve control to be excised, if nothing else. Immediate term, there are political motivations at play in today's yield curve, no upper band policy. To what degree of contribution it is, I don't know, but it's not zero. Yeah. Absolutely agree. I think the analysis I gave was pretty okay. Oh, actually, shit. Yen is getting hammered, and the Ministry of Finance yen interventions are far more limited in capacity, efficiency, and sustainability and yen stability then the BoJ's flexible day-to-day JGB buying activities. Oh my god, that's exactly the analysis that I gave in the Blackboard. I mean, it's in different words, right? It's in my own words, and this is in Nakamura's words, but this is effectively the same idea. Yeah, the BoJ is looking into the future, saying, oh crap, if we don't lift that, we're going to be forced to buy all these JGBs, and it's going to weaken the stability of the yen. We need to remove this cap. Oh my god, man. Yeah, that was I mean, now that I'm actually looking at, so this is why it's important you look at the expectations and analysis of other market participants. PM Kishida administration is getting slaughtered in public approvals to lowest levels, and it's because of JPY, perhaps not directly so. Japan is pissed off because of the FX rate. Oh man, I love Weston. He's just, yeah, man, he's got great commentary. Him and Steno from Steno Research, right? But JPY getting crushed makes for many varied and idiosyncratic forms of economic misery. Gotcha. Alrighty, let's move on to something else here. Oh, actually, this is the old firm that Steno used to work at Nordea. Oh man, the whole story of how he got kicked out of Nordea was interesting to say the least. Headline inflation drops below 3% in Europe, right? For the Eurozone, right? When we looked at our economic little calendar, and wow, I'm making a lot more money now. It looks like the low for the day could be in, you guys, on Aussie dollar. Let me go ahead and do this, just so it's a little easier to see. Yeah, you guys see that? We got a peak down here at the low down here. The question though is this gonna hold? I mean, for the week, there's maybe a 7% chance. It could probably be the low on the day if I'm looking at these daily ranges, right? That could be the low for the day. But if I look at, and I'm looking at Aussie dollar, right? But then if I increase the range from looking at it day to day, looking at the daily probabilities to the weekly probabilities, I don't know, man. That looked like that's probably the top of the week, and it looks like the bottom of the week's probably around 63 here on Aussie dollar. And I mean, all things considered, you know, the Aussies on November 7th, which is over here, right? This is the next RBA meeting. And if I can, let me go into the Discord and find the RBA rate decision. There we go. Yeah, oh, by the way, this is the new head of Westpac. This is the new chief economist of Westpac who's taken Bill Evans' position. Bill Evans is still at Westpac as a senior advisor and working still at Westpac, helping out. But this lady here, if I could recall her name, Lucy Ellis. She was, it's right here, chief economist for Westpac and ex-RBA assistant governor. So she is from the RBA and came pretty much from the RBA to Westpac. And now effectively runs the show at Westpac. One thing I wanted to bring up is this ASX. This is kind of, like, you guys know how there's this thing here, like the FOMC FedWatch tool, right? Well, there's other versions of these tools for other central banks. So here's the probabilities for the December meeting, and here's the probabilities for tomorrow's FOMC meeting, right? It's expected to be a hold 99%. So, you know, no terrible news there for preparing for FOMC. But if you look at the RBA version of that, the probability as of today for a rate hike or no rate hike out of the RBA over here on the 7th of November, it's effectively 50-50, right? October 31st, 50% for no change, 50% for an increase to 4.35%. And you can see the probability split expectations for a 25 basis point rate hike. And it hasn't changed too significantly since the 24th of October. And you know what? One thing that I like about this site is that you can actually see how the probabilities change over time in a series. Whereas on the CME's version, I mean, is there a historical? Oh yeah, there it is. This is the historical probability. Like, it's not that clean of a chart, but at least you can get that information if you really wanted, right? So yeah, this shows you the breakdown over time of the different probabilities. Like, who say you can't get it? It's just I don't like this particular chart layout because it's just way too many lines. So then you have to click all these lines, turn all these lines off, and then figure out like, okay, which ones do I need now? Maybe these lines, these 4 lines. And I never see anybody do the CME Fed Watch tool under this visualization because, well, look at it over here. There's nothing to display. It's just a big, like, there's lines here at the top, lines here. This is the bad visualization. Compared to this, like, it's so straightforward. Okay, the line's at 50, that means 50% probability of a hike, 50% probability of no hike, whereas this is just, you know, unreadable. It's a bad chart. It's just finicky. And there's my little technical rant and whatnot for the day. Let's see here. Why is Japan not what? Hold on, there's a thing. What, not having inflation yet? I'm pretty sure Japan is having inflation. Japan's inflation is accelerating. I mean, if you read these outlooks, they explicitly say from Japan's point of view, from the Bank of Japan's point of view. Like if you search inflation here, literally right here at the top, meanwhile, toward the end of the projected period, which is 2025, underlying CPI inflation is likely to increase gradually toward achieving the price stability target. And then if you keep going, inflation expectations have risen moderately. Inflation is likely to increase gradually. All right. Let's see here. This is mainly because while the extension of the government's measures to reduce the household burden of higher gasoline prices, electricity charges, and gas charges, so commodities and utilities, will push down year-on-year CPI inflation. Cost increases led by past rise in import prices have been passed on to consumer prices to a greater extent than expected. So even though they've used government stimulus to bring down some retail energy prices, they weren't able to pass those on to imported goods. And that's hit them. Let's see here. Fiscal 2023. For 2024, on the other hand, they are projected to push up the rate due to a waning in the effective measures pushing down. Yeah, so next year, all of these government policies are expected to exit the year-over-year measures. So they're saying, hey, there's going to be some positive drift on CPI going into 2024 as those year-over-year measures get knocked out of the metrics. Unless they do more stimulus, unless they do more fiscal stimulus. Okay. We got this article here from Nikkei. Yen weakens past 150 against dollar after BoJ tweaks policy. The yen strengthened after last night's Nikkei news report, but there was nothing more in today's BoJ announcement that was reported. Some investors had hoped for an increase in the upper limit of the 10-year JGB yields to 1.5%, for instance, elaborating on the currency's weakness. However, the BoJ's policy decision was not only aimed at correcting the yen's weakness, it was a comprehensive decision aimed at also improving the functionality of JGB operations. And I think I roughly hit the nail on the head. At least I hit the nail. At least. I was like, okay, the Bank of Japan is looking forward, seeing that the CPI is going to come, and they know that CPI is probably going to continue increasing. So at some point, they're going to end up hitting that 1% number. So they're just kind of getting ahead of the inevitable. As far as FOMC goes for next week, it's going to be pretty, or for tomorrow, it's going to be pretty straightforward. Dollar's probably going to get stronger on the hike, which is one of the reasons why I'm going to probably hold on to this. Maybe this goes down to the mid, 62s or whatever. It'll probably go to some monthly low, if I'm not mistaken. Yeah, it'll probably go, if I go here. Actually, I think that's the weekly spot. Let me go ahead and do a little drawing real quick. Like this spot around here. Let's bring up the weekly. Yeah, see, so it's like somewhere around here, maybe by end of week. Yeah. So I'd expect 62.8 by the end of the week. I'll go ahead and put a line in there. I don't mind. Something like that. And then let's set that to red. Put in today's date. There we go. Yeah, you can actually see on USD-CAD. Actually, no, what was it? Yeah, it was on USD-CAD. I just don't have my drawings here. Sync globally. There you go. So yesterday on the 30th, I was like, I have some negative expectations here. This was only supposed to be a short trade for like a 24-hour period. And now we've rocketed, and now we have FOMC coming out. And I'm like, well, now instead of having to buy FOMC down here, I guess I'm just going to hold on to this trade here and take this up to here. And the Canadian economy is hit particularly hard going forward. Man, oh man, I have just kept on going and going and going. I got my energy back. I got my energy back to stream, and I got my energy back to just keep going at it when it comes down to breaking down some of this analysis. So I think for all intents and purposes, I've covered what I wanted to cover in the stream. I've probably showed more than I probably needed to. I've gone on for like, yesterday's stream was 30 minutes. That was a nice size. Now the stream's getting on close to the normal 1 hour show, right? But as time goes on, the 1 hour is probably going to be the standard. Maybe if I get organized and like I spend time compressing the show, organizing the show specifically, but this is a very interactive live stream. Like, you guys chat, I go ahead and I commentate on it, and I just go on and on and on. But now we're hitting to the end of the hour. I think it's a good time to call it. Give me some time to program some improvements to the range probabilities indicator here for the rest of the day. I'm very excited for the next update to come out for this indicator. It is it is pretty damn good. Good quality of life update. In all seriousness, very, very good quality of life update. Alrighty, you guys. Let me go ahead and play the tune. Thank you guys for watching. I've been your boss. Yo boss. And I'll see you guys tomorrow.